12 of 21 series are aligned with a mild contraction regime this morning. That is a moderate level of mathematical agreement across the framework. The current macro regime is contraction mild, with a confirmation score of 12 out of 21. In the framework, a contraction. Mild macro regime means growth momentum is decelerating at a measured value of -0.11, while inflation momentum is also decelerating at -0.02. The coherence score sits in a moderate band, indicating that the 21 series are not fully synchronized, but a meaningful cluster is pointing in the same direction. The confirmation score of 12 out of 21 has, by our historical work, persisted in roughly 27% of comparable cases over 3-month windows when reached from similar configurations. Compared to last week, growth momentum has softened within the framework's reading, while inflation momentum has continued to edge down, reinforcing the mild contraction label. Historically, environments like this have felt like grindier markets, high-quality bonds often steadier, defensives more resilient than cyclicals, and broad equity indexes more uneven, a record of past behavior, not a roadmap. Let's start with interest rates. The 10-year U.S. Treasury yield is around 4.66%, with the curve modestly positive between 2 and 10 years. In the framework, this sits under a red momentum label, defined as yields rising or holding at elevated levels while growth momentum is negative. Market participants watch the 10-year because it condenses views on inflation, policy, and long-term growth into a single price. The question it raises is whether current yield levels make carrying duration, leverage, or equity exposure feel more or less comfortable relative to recent months. In our framework's reading of comparable periods, this roughly coincided with choppier equity index behavior and episodic pressure on long-duration assets within a 1 to 3 month window. An observation under our methodology, not a forecast. What would challenge this read is a clear move lower in yields alongside stabilizing growth indicators. On labor, the engine is watching initial jobless claims and non-farm payrolls together. Recent data have shown payroll growth cooling while claims remain relatively low, a configuration the framework currently flags with a red momentum label, mathematically defined as employment growth slowing, while broader growth momentum is negative. Markets care because labor conditions feed directly into income, spending, and corporate margins. The core question for participants is whether this labor mix changes their comfort with earnings assumptions and balance sheet risk. In our framework's reading of comparable periods, this roughly coincided with more cautious behavior in cyclically sensitive sectors over the subsequent weeks, an observation under our methodology, not a forecast. A re-acceleration in hiring or a renewed decline in claims would challenge this configuration. Credit is the third pillar. High-yield credit spreads, the extra yield investors demand to hold riskier corporate bonds, have compressed from stress levels but remain sensitive. The framework currently treats spreads as yellow, defined mathematically as neither widening aggressively nor tightening into exuberant territory. Markets watch this because credit is often the first place strain shows up when growth slows. The question it poses is whether the compensation for holding credit risk feels adequate given the macro backdrop. In our framework's reading of comparable periods, this roughly coincided with credit markets trading in relatively orderly ranges while pockets of stress rotated by sector, an observation under our methodology, not a forecast. A decisive widening in spreads would challenge this more neutral reading. For a fourth signal, the engine is looking at equity sector behavior. Technology has rallied strongly, while more defensive groups like utilities and healthcare have lagged over the last session. Mathematically, the framework treats this as green momentum in growth sectors and red momentum in defensives, defined as relative strength favoring cyclicals even as the macro regime points to mild contraction. Markets care because this mix can reveal where investors are leaning despite the top-down math. The question it raises is whether that tilt aligns with each reader's tolerance for volatility and drawdown. In our framework's reading of comparable periods, This roughly coincided with phases where leadership remained narrow and rotations were abrupt, an observation under our methodology, not a forecast. A sustained shift back toward defensives would challenge this pattern. On the conditional map, two specific if-then triggers stand out. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation composites historically showed acceleration in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In regime context, that kind of sustained yield move has in the past coincided with the framework marking transitions toward more inflation-sensitive environments. If the Fear and Greed Index drops below 15 and holds for 5 consecutive sessions, in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 comparable conditions, a historical characterization, not a forecast. In regime terms, that kind of sentiment washout has previously led the engine to flag lower confidence in any single configuration and to record more frequent regime shifts. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated, rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework. A reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine monitors 407 symbols across 4 layers, independently of regime, and the Given engine keeps both the 21 series environment view and the symbol conditions visible for members to study. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. May, potential, and educational are the posture. This is model math, not instruction. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening. See which sectors are leading, and learn to read what's driving it yourself. That live view is the observation desk, the same 21 series and 407 symbols founding members study each morning, the environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.